I have given some questions on amendments, so that you can see in my website. If you are having solved workbook, it is there at the end of that book. I have given even separately also here in downloads for everyone. I have given CA final IDT questions based on amendments for May 25 exam. So in this approximately some 26 questions I have given. So just to follow these 26 questions, it's a high possibility out of these 26 questions easily 2 to 3 questions can come in exam, not necessary verbatim. Verbatim if it comes, I will become pan India faculty, okay. So it will not come like that, but they will modify in these lines, they will be creating, okay. See this question number 26. XYZ Private Limited is registered, is engaged in manufacture of tobacco and pan masala. The company is required to register its manufacturing machines under a special procedure notified under section 148 of the CGST Act. However, during an audit in April 2025, it was found that XYZ Private Limited failed to register 5 machines used for manufacture of tobacco products. On the basis of this new section 122A, the proper officer issued a penalty order on April 20, 2025 for non-registration of machines. Compute the amount of penalty as per the penalty order. So penalty payable under 122 subsection A of CGST Act. CGST Act is 1 lakh for each unregistered machine, which means 1 lakh into 5 lakhs, but this is under CGST Act. Suppose if they ask under total penalty into 2. So 10 lakhs will be the penalty, got it? So 1 lakh under CGST Act. Mostly you will get provisions only under CGST Act. 99.999999% of the cases it will be CGST Act only will be tested in exam. IGST Act rarely it will be coming in exam. So don't break your head in that. CGST Act only you need to first determine. Next, what is the course of action on the part of XYZ Limited after receipt of the penalty order? They should pay this penalty and register the machine in accordance with the special procedure within 3 days of receiving the penalty order. And what will happen if they are not registering within 3 days from the penalty order, then the machines will be seized, okay. HDFC Bank, question number 14. If you have solved workbook, you see, or questions on amendments, it is there in my YouTube website in downloads. HDFC Bank, an acquiring bank registered under GST, participate in the incentive scheme for the promotion of RuPay debit cards and low value UPI transactions as a scheme run by Ministry of Electronics and Information Technology. Under this scheme, HDFC Bank receives an incentive of 10 lakhs. What is the treatment of this 10 lakhs? As per CBIC circular, that 10 lakhs will be treated as subsidy from central government. Therefore, it is not treated as value, not treated as value for payment of GST. It is excluded from the value. And as per NPCI guidelines, HDFC Bank is required to share a portion of this incentive with its ecosystem partners involved in facilitating digital payments. HDFC Bank distributes the incentive to stakeholders like Paytm Payments Bank and Pine Labs, which help to facilitate UPI infrastructure. In addition to the compliance sharing, HDFC Bank also shares 2 lakhs with XYZ Marketing Limited, a marketing consultancy that is not part of NPCI specified ecosystem. So therefore, this 4 lakhs which is retained by HDFC Bank, anyhow 10 lakhs collected by them is excluded from the value, that is not treated as like value because it is subsidy from central government. Even 3 lakhs received by Paytm and 3 lakhs received by Pine Labs, these two are also deemed to be subsidy from central government and that will not be included in the value for payment of GST. However, XYZ Marketing is not specified, not part of NPCI specified ecosystem. So whatever 2 lakh rupees received by XYZ Marketing Limited is not deemed to be subsidy from central government. Consequently, it is their consideration on which they need to pay GST. Now answer the following questions based on the facts given above. Is the incentive of 10 lakhs received by HDFC Bank from METI subject to GST? No. Is the sharing of incentive by HDFC with Paytm and Pine Labs taxable under GST? No. Is a further sharing of 2 lakhs with XYZ Marketing which is not compliant with NPCI guidelines taxable under GST? Yes. What is the total taxable value on GST payable if any? 2 lakhs plus 2 lakhs into 18%. So on that GST will be payable. So XYZ Marketing Limited shall pay GST on rupees 2 lakhs. So that is with respect to this, and they will raise invoice to whom? They will raise invoice to HDFC because XYZ Marketing Limited will raise invoice to HDFC Bank. And can HDFC Bank take ITC with respect to that? Yes. So because we don't have any restriction with respect to that, they can definitely take ITC. See this question number 13. PQR Limited, a manufacturer, entered into contract with DEF Limited, a distributor, on 1st April 2024. The supply was made on 10th May with a value of 25 lakhs and applicable GST rate was 12%. And payment terms required: full payment within 30 days of invoice date. A post-supply discount of 7% was agreed upon. Conditional on DEF Limited successfully selling 80% of the goods within the quarter. So if you are selling 80% of the goods within the quarter, you will get a post supply discount of 7%. So definitely it's a post supply discount, and the terms are also agreed before at the time of supply. By 30th June 2024, DEF Limited sold 85% of the goods, making it eligible for the 7% post supply discount. Consequently, on 15 July, PQR Limited issued a credit note for such discount to DEF Limited for post supply discount. DEF Limited had availed the ITC on the full invoice value as they complied with the conditions for availment of ITC. To comply with the provisions of 15(3)(b), DEF Limited is required to reverse the ITC proportionate to post supply discount. Now question number 1, how much ITC needs to be reversed by DEF Limited based on the credit note issued by supplier? So please see what is the value for which discount will be given. So 25 lakhs is the total price. On that, 8% will be the discount. So the 8% or 7%? 7%, that is 1,75,000 is the discount. What is the tax component in the discount? So this 25 lakhs is excluding GST. So therefore that 1,75,000 discount is also excluding GST. On the top of that, into 12%, that is 21,000. So that is the ITC component to be reversed by DEF. So DEF has to reverse an ITC component of 21,000 based on the credit note given by supplier under section 34. What is the consequence to PQR Limited based on that credit note? So for supplier, the recipient should reverse the ITC, but for supplier, their liability gets reduced. So liability of PQR gets reduced as and when credit note is issued and reported in GSTR 1. Then how PQR Limited can prove that recipient has reversed the ITC? What is the ITC component? Assuming that this is the only transaction in this financial year, what is the ITC component? 21,000, which does not exceed 5 lakhs. So then in that case, the recipient should give a declaration to the supplier that they are going to reverse the ITC. So as per CBSE circular, as ITC reversal in a financial year does not exceed 5 lakhs, PQR Limited shall obtain a declaration from DEF Limited that they have reversed the ITC along with supporting documents, that is GSTR 3B or DRC 3. Okay. Then next, what will be your answer in 3 above? If the ITC to be reversed is 5,50,000 in this financial year, means like this, there are multiple transactions which is happening throughout the year, and for this particular supplier's credit note, they have to reverse an ITC of 5,50,000 as this amount exceeds 5 lakhs. So therefore we need to, that is supplier should get a certificate from DEF Limited CAR CMA certifying that they are reversing the ITC along with UDIN and supporting documents, and this procedure to be followed even for the past periods. So that is with respect to this. Infosys Limited, question number 15, page 656. Question number 15, Infosys Limited, a registered company in India, is engaged in IT consulting and software services. Infosys Consulting Incorporation, its related foreign entity based in USA, provides software development, support and consulting services to Infosys Limited in India. Both entities are related person under the GST provisions. In October 2024, Infosys Consulting Incorporation provides software consulting services worth 20 lakhs to Infosys Limited. So definitely it's an import of service from a related person. Since this transaction is an import of service, Infosys Limited is required to pay GST under RCM. Additionally, Infosys Limited is eligible for full ITC on this transaction. So now, moreover, Infosys Consulting Incorporation also provides strategic advisory services to Infosys Limited without issuing any invoice. The domestic entity Infosys Limited estimates the market value of these services to be 5 lakhs, but no official invoice is generated for these services. So, as the recipient is eligible for full ITC, in the first case for 20 lakhs invoice is issued, correct? Invoice is issued, and therefore we will take 20 lakhs as the value, whereas in the second case 5 lakhs, no official invoice is given. As invoice is not issued, it will be taken as nil. And first question, whether Infosys Limited is required to issue any invoice to Infosys Consulting Incorporation. Remember, in case of services or goods covered under RCM, when the supplier is unregistered and the supplier is not giving invoice, the recipient has to give invoice to the supplier under section 31 subsection 3 clause F within 30 days. That is also an amendment. In tax invoice, that's an amendment. The recipient has to give invoice to the supplier within 30 days from the date of receipt of goods or services. See here, as per section 31 3F, Infosys Limited shall issue invoice to Infosys Consulting Incorporation within 30 days from the date of receipt of services. Then second, who is required to pay GST in the present case and what is the value on which GST will be payable? So GST payable by recipient under RCM because it's an import of services. Section 9(3) Red with notification 13/2017, GST payable by Infosys under RCM. Then if Infosys Limited, and what is the value? The value will be only 20 lakhs. Why only 20 lakhs? Why this 5 lakhs we cannot take? Because of the CBIC circular. The CBIC circular says if the invoice is not issued, the value shall be taken as nil. And only for 20 lakhs the invoice is being given, so we are taking that. And if Infosys Limited declares 20 lakhs as the value of software consulting services from Infosys Consulting Incorporation in the self invoice, they declared only 20 lakhs. Compute the GST payable by Infosys Limited, only 20 lakhs. Applying the above circular, value of supply shall be invoice value as recipient is eligible for full ITC. If value declared in invoice is 20 lakhs, then GST payable under RCM on 20 lakhs into 18%, 3 lakh 60. What if in the invoice they mention 25 lakhs? Then that 25 lakhs will be taken as the value. Got it? That is the application of this particular circular. XYZ Limited, an Indian company registered under GST, provides corporate guarantee to 4 different entities. ABC Limited, in which XYZ Limited holds 60% equity. Is it related? Yes. For a loan of 10 crores from a bank for a period of 1 year, XYZ Limited does not charge any specific consideration for this service. So what is your answer with respect to this? So 10 crores into 1%. So that will be 10 lakhs. Both are in India? Yes, both are in India. So therefore 10 crores into 1%, 10 lakhs will be taken. There is no actual consideration. Second, PQR Limited, in which XYZ Limited holds 20% equity. Definitely they are not related because with 20% equity they cannot become related. For a loan of 20 crores from a bank for a period of 2 years, XYZ Limited charges an annual fee of 2 lakhs for providing this guarantee. So it is not a related party transaction, but it's a normal transaction chargeable to GST under 71A section 15. That is 2 lakhs will be taken as the value, and first year 2 lakhs and second year will be 2 lakhs. See the answer. Transaction value under section 15 is 2 lakhs in first year and 2 lakhs in second year based on the invoice issued. Third case, LMN Corporation, a company located in Singapore, who is the largest material supplier of XYZ Limited, for a loan of 15 crores for 1 year. No consideration is charged for this guarantee. First of all, largest material supplier and all is not a related party. So therefore it's not a related party transaction. Consequently, there is no supply here because there is no consideration. First check. So that's what, where every time you see a question, you need to check whether it is supply or not a supply. In this case, it is not a supply. Why it is not a supply? There is no consideration, and moreover it is not from a related person. So what are the 4 activities even though without consideration constitute supply? D, R, I, P. D for disposal of business asset on which ITC avail. Then related party transaction including transaction between distinct person, import of service from a related person or other establishment located outside India, principal agent transactions. Okay. Then so that's why it is not a supply and GST payable shall not arise. DF Limited is related entity located in UK. So for a loan of 30 crores for a period of 3 years, XYZ Limited charged a consideration of 45 lakhs for providing this guarantee. Rule 28 sub rule 2 is not applicable. Why not applicable? Because where is the recipient located? Where is the recipient located? Outside India. DF Limited is related entity located in UK. So 28 sub rule 2 will not come, but the value will be determined as per 28 sub rule 1. Value under rule 28 sub rule 1 is open market value to be determined. If that is not available, like, kind and quality. If that is not available, cost plus 10%. Okay. Transaction value not applicable as this corporate guarantee is to a related entity, and rule 28 sub rule 2 also will not be applicable. Why not applicable? Because the recipient is located outside India. Got it? Say this. Question number 24. Question number 24 you can see if you have solved workbook. Due date of filing GSTR 3B is 20th of next month. Month is July 2024. My gross liability is 8 lakhs. ITC availed is 3 lakhs. And what is the net liability? 8 minus 3, 5 lakhs. I maintained that 5 lakhs as on the due date. For July, what is the due date of 3B? 20th of August. So as on 20th August, I maintained 5 lakhs in my cash ledger. Again, August 2024, my gross liability is 4 lakhs, ITC is 1 lakh. So 4 minus 1, 3 lakhs. 3 lakhs I have to maintain, but what is a mistake I did? I deposited only 2 lakhs. How 2 lakhs? Already 5, now it is 7. Means 2 lakhs I have deposited as on 20th September, and thereafter 1 lakh I deposited by 30th September. Then again, September 2024, gross liability is 6 lakhs. ITC availed is 4 lakhs. So the difference is 2 lakhs. So that I maintained by 20th of October, because for September 2024 GSTR 3B is due date is 20th of October. So I deposited. Now what I did for all these 3 months, GSTR 3B for all the above months is filed on 28/12/2024. So correct that, 28/12/2024. Now compute the applicable interest that is payable. Now, so what is the interest payable? First we will see for July month. July month, what is the net liability? 5 lakhs. Whether that 5 lakhs I am making payment, like I have maintained as on the due date of 3B, yes, I am maintaining the balance as on 3B due date, so no need to pay interest, because the net liability 5 lakhs, due date of July is 20th August, I maintained that, so I don't have to pay interest. Is that clear? Then go to August month. August month, what is the net liability? 3 lakhs. 3 lakhs. Whether in that 3 lakhs, I maintain 3 lakhs as on the due date of 3B? No. Only 2 lakhs I have maintained. 1 lakh I have not maintained as on the due date of 3B. So on 1 lakh we need to pay interest. At what rate? At the rate of 18%. From which date to which date? You see the question and tell me. From which date to which date? 20th September to? Wrong answer. 30th September should not be taken. See, this proviso says if you maintain sufficient balance, in the due date of 3B, then interest not payable on account of delay in filing 3B. Otherwise, this provision will not come. If this provision is not coming, then section 50 will come. For delay in filing 3B, you need to compute interest from which date to which date? From the due date till the actual date of payment. What is the actual date of payment? Actual date of filing 3B. What is the actual date of filing 3B? 28 December 2024, not for this 10 days. One simple mistake they have done. What is that? Rather than putting on 20th September, they have deposited on 30th September, because of which they will end up paying interest from 20th September till the date they are actually filing 3B. Is it clear? So 28 December. So count the number of days. In September 10 days, October 31 days, November 30 days, December 28 days. For 99 days they need to pay interest on 1 lakh. Are you understanding this? So see there, interest not applicable on 2 lakhs deposited by 29. However, interest is applicable on 1 lakh. Because see, this provision not applicable for 1 lakh. If this provision not applicable for 1 lakh, the regular provision will be there. Got it? So not interest is payable on 1 lakh deposited after the due date. Interest computed from the due date till the date of payment, that is date of filing 3B, because date of payment of tax is the date of filing 3B only, and interest payable will be 1 lakh into 18% into 99 by 365. Where is it given? The date of payment is date of filing 3B. Clearly I have given. Date of payment will be taken as actual date of filing 3B because of that reason. Whereas for September month, if you see 6 lakhs minus 4 lakhs, how much? 2 lakhs. Whether the 2 lakhs is maintained as on due date? Yes. So whether any interest is payable in this case? No. Interest is not applicable as 2 lakhs is deposited by 20th of October 2024. Good question, no? So this can be tested in exam because of the amendment, this point of amendment. Then one more question I just wanted to give you here in this regard. So payment process chapter itself, you can take in solve workbook. So there is one question, slightly I modified that question. This question. Question number 3, which is in page number 328. Miss Nitya has following balances in her electronic cash ledger as on 28 February as per GST portal. So, CGST, SGST, IGST, this is the balance in the cash ledger as on 28 February. Her tax liability for the month of February for CGST, SGST was 75,000 each. She failed to pay the tax and contacted you as legal advisor on 12th April to advise her as to how much amount of tax or interest she is required to pay, if any, by utilizing the available balance to the maximum extent possible as per GST law. She wants to pay tax on 20th April. This is which month? February month liability. For February month, what is the due date? March. So date of collection of GST 18 February, no other transaction after this up to 20th April. So 20th March is the due date. So but when it is being paid? 20th April. As on 20th March, if sufficient balance is there in the cash ledger, we don't have to compute interest, correct or not? Now 75,000 is the CGST, SGST liability. Now go to CGST head. Whether CGST head tax, they have 75,000 as on 20th of March. By 20th of March, no. So CGST only 40,000 is there. What is the balance not there? 35,000 is the shortfall. Agreed pa? 35,000 shortfall. 35,000 shortfall. And next, go to SGST head. Go to SGST head, how much? 80,000. So sufficient balance is there? Yes. Which means on this SGST, interest will not arise. Why interest will not arise on SGST? Because there is sufficient balance. Sufficient balance as on the due date of GSTR 3B. So interest will not arise. Okay. Now, sir, for CGST, 40,000 is there, but you go to IGST. IGST head, how much is there? 45,000. Can we use that 45,000 for payment of this 35,000? Yes. Because in cash ledger, there is no restriction on cross utilization. Any head can be utilized for payment of any head. If that be the case, then 45,000 can also be used for payment of 35,000. Means they have maintained the sufficient balance. So therefore, on the 35,000 also no need to pay interest. Wrong answer. Wrong answer. Because they have not specified that it should be headwise or total balance. They have not specified headwise or total balance. Got it? So right there, headwise or total balance not specified. Then what is the interpretation in that case? You take the interpretation as headwise strictly, because that much of balance should be maintained in terms of section 49 subsection 10, like that it is given, which means that headwise only should be taken. Got it? That is the assumption. So in exam, suppose if at all you get this question, as there is no clarity, ambiguity is there, you need to write the assumption. Of course, they will not go this much deep because they are not a psycho like me. Got it? So they will not think of all these things. But suppose in case if they are giving, you write the assumption. What is that assumption? That headwise the balance should be maintained. As there is no balance headwise, the interest will be payable on 35,000. That is the assumption I have taken in this case. That's why I computed interest on 35,000. Is it clear here? 35,000. In the given case, since Miss Nitya wants to pay tax on 20th April, interest payable on amount of CGST 35,000 into 18%. And I gave the explanation also. As per section 49 subsection 10, any amount of tax, interest, penalty fee or any other amount available in the cash ledger under CGST Act can be transferred to such cash ledger for integrated tax. Okay, thus amount entered under any minor head and major head, so can be cross utilized. So why we are taking this particular assumption here? So because that is after that is, see, balance we can transfer, and then we can utilize. So not that directly we can utilize. So using PMT 9, we can shift the balance for 45,000 to this, and then we can use it for payment of tax. But that particular point is for transfer of balances, etc. and all. So means we should maintain the headwise that much of balance. So that is the view which I have taken. Maybe if they come out with a clarification, so that I will update for November 25 exam. Got it? But right now this is the answer to be followed for exam. So 35,000 into 18% into 31 by 365. Hope you got the clarity about this. Say this. Question number 25. ABC Exports Private Limited, an Indian exporter, imported raw material worth 10 crore on 1st January 2022 for manufacture of goods intended for export. At the time of import, ABC Exports availed exemption under notification 78/2017. So at the time of import, what this person did, they did not pay customs duty worth 10 crore worth of raw material. They did not pay customs duty including IGST and compensation cess, while only availing exemption on basic customs duty. Subsequently on 31st March 2024, so after some time, after 2 years like that, because 1st January 2022 is the date of import, on 31st March 2024, the company realized that they were not eligible for a refund of IGST paid. They already paid. Had they know this provision, they would not have paid IGST on export. They would have went for export without payment of IGST option, but they have paid. Okay, it's a post-mortem exercise what we are doing now. Paid IGST on export of 20 crore as per Rule 96 sub Rule 10 of CGST rules. Means this 20 crores is gone? Yes, this 20 crores will be lost. But to recover this 20 crores from government, so there is a way. What is that? On this 10 crores, whatever IGST and compensation says, that we need to pay along with interest. Due to the availed exemption on import inputs, to regularize their position, ABC Exports now intends to pay IGST and compensation cess along with interest on the imported inputs to claim the refund of IGST paid on exports. Details of the case: value of inputs imported 10 crore, basic custom duty 10%, IGST 18%, compensation cess 12%. ABC Export Private Limited requests your assistance in determining the following: the total IGST and compensation cess payable on imported inputs including the interest. So how much is the assessable value? The assessable value will be 10 crores. On that, basic customs duty 10% and social welfare surcharge will be 10%, but it is exempted because now when you are doing under reassessment, you don't have to pay all those things. What you need to pay is only IGST and compensation cess. So it is a trap. They have given basic customs duty. We don't have to take that, and we need to take only IGST. How much? 18% and compensation cess 12%. 1 crore 80, 1 crore 20. So literally 3 crores you need to pay, and this 3 crores along with interest. At what rate? Interest at the rate of 15%, not 18%, 15%. From which date? From 1st January. So they are not under deferred payment option. If deferred payment option is given, then the due date will be different. So they are not under deferred payment, means immediate payment. Immediate payment means on the date of import itself, they are required to pay the customs duty. So from the date, that is 1st January 2022 till the date of payment. What is the date of payment? 31st March 2024, because that date they are ready to make the payment, 31st March 2024. So how many days the interest will be payable? So in January, so you count that, so total you will be getting 821 days. So 3 lakhs into 15% into 821, because in this process February 2024 is coming. As February 2024 is coming, in the denominator we need to take 366. So 1,94,262 is what we need to pay. So 3 crores also we need to pay, and 1 crore, literally 4 crores we need to pay. Okay sir, if we pay 4 crores, what is the benefit we will get? How much you will get? 20 crores. IGST paid on export is 20 crores. So that IGST paid we will get. So that is second point. First point you understood how much we need to pay along with interest, and what are the additional conditions if any to be satisfied. So bill of entry originally filed needs to be reassessed under customs for payment of above IGST and compensation cess along with interest. What is the time limit for application of refund in this case? application to be made within 2 years. It is export. It is export means the date on which the goods leave the country. So goods leave the country for export. Then 4, the total refund of IGST that they can claim on exported goods after making the necessary payments. So that is 20 crores. 20 crores of IGST paid. As export of goods is upon payment of IGST option, refund of IGST paid on export, that is 20 crores, can be claimed in form GST RFD1. Now only they are exporting now. Now only they are exporting. So 2 years is the time limit. So they have ample time limit to make the refund application. Is it clear? 2 years from the date of export, not import. 2 years from the date of export. Question number 15. Question number 15. Infosys Limited this we discussed no yesterday. I think in this I told you, correct, in this itself I told you when they can take ITC like that. In this itself I told you, that is in case of RCM, yesterday itself we completed this discussion. In case of RCM, the invoice needs to be given within 30 days, okay, within 30 days from the date of receipt of services. So when can they take ITC? So whenever they issued the invoice to the supplier, they can take ITC with respect to that, okay. TechPro, question number 17. TechPro Solutions Private Limited, a registered person under GST, had its registration cancelled by the proper officer on June 1, 2024 under section 29 of CGST Act. Yes, section 29 of CGST Act deals with cancellation of registration due to non-compliance with filing of returns. The company has received the input services for which it was eligible for ITC during the financial year 23-24. For financial year 23-24, what is the time limit for availment of ITC? 30th November 2024 or date of filing annual return, whichever is earlier. As the question is silent about date of filing annual return, usually when the question is silent about date of filing annual return, you take the due date of filing annual return itself as the date of filing annual return. What is the due date of filing annual return? 31st December 2024, whichever is earlier, that is 30th November 2024 is the time limit for availment of ITC for this financial year. Got it? But from June 1st, what has happened? 30th November 2024 is the time limit. From June 1st, what has happened? See the question. From June 1st, our registration got cancelled. Okay. Then, so therefore, on August 25, 2024, TechPro Solution applied for revocation of the cancellation of its registration under section 30 of CGST Act. The registration was revoked by the proper officer on September 5, 2024, allowing TechPro to continue its business operations. However, during the period of cancellation, TechPro Solutions received several invoices and debit notes for supplies made between June 1, 2024 and August 25, 2024. This is the facts of the case. Now, the company is now considering the possibility of claiming ITC on invoices pertaining to the supplies made during the period June 1st to August 25, 2024. That is the period of cancellation. For this, the regular provision only, no issue. What is a regular provision? What is the financial year for which this invoices pertains to? Not 23-24, 24-25. For 24-25, anyhow we have a time limit for availment of ITC, that is 30th November 2025 or date of filing annual return, whichever is earlier, that is 30th November 2025 time limit is there. Happily we can take ITC with respect to that by the time limit, correct or not? That is the answer. Time limit for availment of ITC in respect of invoices for the period 1st June 2024 and 25th August 2024, that is the period of cancellation of registration, that is invoices pertains to financial year 24-25, A 30th November or B date of filing annual return, assume that it is 31st December 2025. So the time limit for availment of ITC will be what? Whichever is earlier. Which is earlier? 30th November 2025. Is it clear? Understood here? This is for which period? This is for the period June 1st, 2024 to August 25, 2024. That is the period of cancellation of registration. For this, they have not given any amendment. This is normal. This is there. Even before also it is there. Now also it is there. But second point, you see, debit notes issued during the financial year 23-24 but not availed before the date of cancellation of registration. For 23-24, we should have availed the ITC at the time, but we missed. When we missed, we have a time limit by which we could have taken, but what happened? Cancellation of registration came, so we could not take. Now can we take? For that only they have brought in amendment. A, the regular time limit. What is the regular time limit? 30th November 2024 or date of filing and return, whichever is earlier, that is 30th November 2024. B, 30 days from the date of revocation order. What is the revocation order? September 5, 2024 plus 30 days, that is October 5, 2024. Whichever is later is 30th November 2024 only. So the regular time limit is only later. So 30th November 2024 only will be taken. Is it clear here? So the regular time limit or the 30 days from revocation order, whichever is later, that is 30th November 2024. Now suppose if this question is modified and in that they are asking what if revocation order is passed on 15/12/2024, then what would have happened? Then in that case, the regular time limit is 30th November 2024 or the date of filing and return, whichever is earlier, is 30th November 2024, or 30 days from revocation order. The revocation order will be 15/12/2024 plus 30 days, that is 14/1/2025, whichever is later. So 14/1/2025 is the time limit by which they can avail ITC. Understood here? So like this, they can definitely make a question on this time limit connected with cancellation of registration because of the amendment. Question number 21, page 659. HDFC Life Insurance Company Limited, a registered entity under GST, offers life insurance policies. They compute the value for payment of GST in terms of Rule 32 Sub Rule 4 of CGST rules. In July 2024, HDFC Life Insurance received total premium of 60 lakhs from customers for various life insurance policies. 30 lakhs of this premium pertains to risk cover policy. How much should be taken as a value? How much should be taken as a value out of this 30 lakhs? 30 lakhs into, so full 100%. Why full 100%? Because it's a risk cover policy. So entire 30 lakhs will be taken. Whereas 20 lakhs of this premium pertains to first year policies. First year policies means 25%. So which means only 5 lakhs will be taken, and 10 lakhs of this premium pertains to policies issued in earlier years. So into 12.5%, which will be 1,25,000. Now you see the total of this. So 30 lakhs plus 5 lakhs plus 1,25,000, that will come to 36,25,000. So this 36,25,000 should be taken as the value, and on the GST will be payable. Now the point is, remaining 75% we are not paying. Can we consider it as exempted? No. So the company has 5 lakh of total ITC. Can they enjoy the total ITC? Yes. So you can see here 36,25,000. The rate of GST 18%, so 6,52,500 minus this entire ITC can be utilized because of the CBIC circular. As per CBIC circular, reversal of ITC shall not arise owing to reduction in value, so 5 lakhs. So net GST payable will be 1,52,500. Like that, they can blend valuation related provision to this circular. Okay. Question number 20. ABC Insurance Limited provides general insurance services for motor vehicles. A customer, Mr. Sharma, has a policy with ABC Insurance. His car was damaged and he chose a non-network garage for repairs, including a total repair cost of 1 lakh. The insurance policy approved a claim of 80,000, which ABC Insurance later reimbursed to Mr. Sharma. Now, scenario number 1. The garage issued 2 separate invoices, one for 80,000 to ABC Insurance and another 20,000 to Mr. Sharma. What is your answer? Determine the extent of ITC available to ABC Insurance Limited in scenario 1 and explain the condition under which ITC can be claimed. What is your answer? As the invoice is in the name of insurance company, they can take ITC with respect to 80,000 only. So 80,000 only they can take ITC. Then next scenario number 2, the garage issued a single invoice for rupees 1 lakh to ABC Insurance, but ABC Insurance only reimbursed 80,000 to Mr. Sharma, even though the invoice is for 1 lakh, but they can take ITC only to the proportionate of 80,000. Okay. Then scenario number 3, the garage issued an invoice for 1 lakh directly to Mr. Sharma, who later got reimbursed 80,000 from ABC Insurance. Now ABC Insurance cannot take ITC because the invoice is in the name of insured. Now again from the beginning, so first case, Sharma has 20,000 invoice. Can he take ITC? No, depends. He is an individual, basically he is an individual. So when he buy a motor vehicle, he cannot take ITC. As he cannot take ITC on motor vehicle purchase, so he cannot take ITC on the 20,000. Second case, the question will not arise because the invoice is not in the name of Mr. Sharma. But third case, entire 1 lakh invoice in the name of Mr. Sharma, can he take ITC? No, because the motor vehicle purchased is not eligible for ITC, so he cannot take ITC with respect to that 1 lakh also. Is it clear? Insurance company definitely cannot take ITC because invoice is not in the name of insurance company. That is the answer for these 3 questions. Explain how the provisions of section 16(2) apply to these scenarios and the implication for claiming ITC. That is, in these scenarios, the payment is not made to the garage, but the payment is made to Mr. Sharma by the insurance company. Even the insurance company is not making payment to garage, but they can take ITC wherever possible. That 180 days condition is not applicable in that case. You read the answer. Even if payment is not made by insurance limited to garage, ABC Insurance Limited to garage, they can avail ITC, and the provision of section 16(2), that is payment to supplier within 180 days condition, is not applicable in this case. So that is about this. Then one more clarification that is related to availment of ITC on demo vehicles. On demo vehicles, can they take ITC? Definitely on demo vehicles they can take ITC, because even though the demo vehicles are not for further supply, lot of two-wheeler, four-wheeler dealers, if you see, they will be purchasing the cars, and those cars they will be keeping it in their showroom for the purpose of giving a, like test drives. So in that case, can they take ITC on those test drive vehicles? So if you see the provision, so first they are purchasing car used for transporting persons, capacity does not exceed 13. So is it covered under further supply? No, it is not covered under further supply. It is not used in the business of transportation of passengers, not for driving skills, then ITC not available. But the CBSE has clarified that even though it is not in further supply, but it assists in further supply, because this particular car is used for the purpose of making the sale of other cars. Moreover, this demo car also will be sold in future when a new model is launched. When a new model of that particular vehicle is launched, so we will be selling the old model. So due to that reason, ITC should definitely be given on the demo cars. That is, ITC available on demo vehicles if they are used for promoting further supply of vehicles. And if demo vehicles are capitalized, ITC is available. Why demo vehicles are capitalized? Won't it be coming under stock in trade? No, it will not come under stock in trade. So the remaining cars will come under stock in trade. So on that depreciation we will not claim. For your information, section 32 depreciation we will not claim on stock in trade. You know that now? Super. Then only on those assets which are capitalized, which means on stock in trade we will not claim. So the question of capitalization will come only on the demo car only. So if the demo vehicle is purchased, ITC is available unless depreciation under 32 is claimed on the tax component. So unless it is claimed on tax component, so that what is it they are telling? So unless depreciation, that is if demo vehicles are capitalized, ITC is available unless depreciation under section 32 is not claimed on tax component. Sorry. So ITC is available. ITC available. Okay. Unless, sorry, correct only. No, I said correct only. So unless depreciation is computed on tax component, correct only what I said. No need to correct it. So that is, if I have added the GST component and I claim the depreciation, then I will not get ITC. That's a usual point. Also, on sale of such capitalized demo vehicles, GST is payable in terms of 18(6). So why 18(6) will come? First I am purchasing the demo car, and that demo car GST paid I have capitalized. I mean GST paid I have taken as ITC, and it is a capital goods on which ITC availed. When we are disposing of, we need to pay GST in terms of 18.6 that ITC availed minus 5% etc., or sale value whichever is higher. If demo vehicles are used for non-business purpose means what? I have seen some dealers, what they will do, demo cars and all they will get, and these demo cars they will use for their personal purpose. Rather than giving it to the people for test drive, they will use it for their personal purpose, okay? And in that case, can they take ITC with respect to that? No. But how department will know all these things? If the demo vehicles are used for non-business purpose, they cannot take ITC, they are telling, or as a part of marketing services for the manufacturer. What is this marketing service for the manufacturer? If you see big malls and all, so even Phoenix Mall, like that one mall is there in Chennai. If you have been to that mall, so completely some 6 to 7 cars are there in the ground floor. Even airport also, if you see one car, they have kept as a display. So a lot of shopping complexes or shopping malls, they are keeping the cars for display. With respect to the cars kept for display, can we use it as a trial run? Say for example, that shopping mall, one car is there. Can I take a test drive there? Give me sir, like Beast movie, I will go on a round and come. They will not give, correct or not? So therefore it is not for a test drive, and due to that reason ITC not available with respect to that car. As a part of marketing service for the manufacturer, ITC is blocked. Now related to that, I have given one question. You can see that it is question number 18. Question number 18, you can see ABC Motors, an authorized dealer for motor vehicle, purchases 5 demo vehicles from XYZ Auto Limited, a manufacturer, on October 1, 2024. These demo vehicles are used for test drives and to showcase features to potential buyers. Each vehicle has a value of 10 lakhs excluding taxes, and ABC Motors receive a tax invoice for the purchase which includes the following: IGST on demo vehicles 1,80,000 per vehicle. So total purchase cost is 10 lakh plus 1,80,000, 11,80,000. ABC Motors plans to capitalize these vehicles in its books of accounts at rupees 10 lakh per vehicle and intends to use them for test drives for a period of 2 years before selling them as used vehicles at a written down value. After 2 years of usage, ABC Motors sells one demo vehicle for rupees 5 lakhs and IGST on the sale is applicable at 18%. Question number 1. Determine whether ABC Motors can claim input tax credit on the purchase of these demo vehicles. If yes, compute the ITC availed. As per CBIC circular, demo vehicles which are purchased and used for trials will be coming under used for further supply, because as they assist in further supply, ITC is available. So in the present case, ITC will be 1,80,000 into how many vehicles purchased? 5 vehicles purchased. So 9 lakhs will be taken as the ITC. Then 2. What will be your answer? If the motor vehicles are capitalized in its books at 11,80,000 per vehicle. If it is capitalized in books for 11,80,000 per vehicle, then in that case, ITC available or not available? Not available. ITC not available. So therefore depreciation can be claimed under section 32 of Income Tax Act on that 1,80,000 component. Calculate the GST payable at the time of sale of demo vehicles. Suppose if ITC is availed on that, how the GST will be payable? So 18 subsection 6. So please see what is the ITC availed. 1,80,000. Only one car is sold na. 1,80,000 minus what is the number of quarters for which it has been used? 8 quarters. After 2 years they are selling. Please observe the question carefully. After 2 years they are selling. 2 years means 8 quarters. So 8 into 5, 40%. So 1,80,000 minus 40%, that will be 1,08,000. Or what is the sale price at which this vehicle is sold? So that is 5 lakhs. So 5 lakhs into 18%, that will be 90,000. Whichever is higher, which is higher, 1,08,000 will be taken. And can the buyer of such demo car can avail ITC? Of course, yes. They can avail ITC if eligible, because basically all these demo vehicles are purchased by travel agencies. because for travel agencies they don't mind whether it is a used one or new one, etc. and all. They will buy because it will be available at a very cheap rate, so they will be purchasing it, and they are in the business of transportation of passengers, so definitely they can take ITC. So buyer of such demo car, if eligible, can avail ITC with respect to this 1,08,000. Now same question if they give, what if they have computed depreciation on the tax component? What if they have computed depreciation on the tax component? Then what is your answer when they are selling this demo vehicle? First, ITC not available, that's okay, but what will be taken as the value on which GST will be payable? You understood my question first? I am telling you, listen to the question first properly. They have purchased the demo car, 10 lakhs plus 1,80,000, 11,80,000. They purchased it, and they have capitalized the entire 11,80,000, and they claimed the depreciation also under section 32. Got it? Now they are selling the demo car as usual after 2 years. Then what should be taken as the value on which GST is payable? 5 lakhs into 18%. Wrong answer. WDV. Margin scheme is applicable. Notification 8 of 2018, which you have written. I made you write for this purpose only. Notification 8 2018 says, whenever motor vehicles, open your book and see. So you have written value of supply while discussing rule 32, sub rule 5. There I told you, notification 8 of 2018. Margin scheme is applicable. What is that margin scheme? Sale price minus depreciable value. How to compute the depreciable value? As if this is the only motor vehicle in the block, we need to compute the WDV. So, and ITC should not be availed, and here we are not availing ITC. So you count the depreciation, and I asked you also, what is the depreciation rate like that in income tax? You said 15%. Okay. So 11,80,000 minus 15% for the first year and minus 15% for the second year. Okay, but directly we cannot take na sir, because it is purchased on October 1, 2024. October 1, 2024 it is purchased means, is it put to use for more than 180 days? Yes. So we can take that full year 15%, and next year, that is next year 2025-26. So there also we can use, yes, because see here, date of purchase is October 1, 2024 to date of sale. Date of sale is October 1, 2026. So now in this case, first for 2024-25, for 24-25 you will claim 15%. Then again for 25-26 you will claim 15%, but thereafter few months are there na in 2026, for that proportionately 15%, no, that like that block of assets method and all is not there, only 15% we need to reduce. So therefore how much will be taken? 11,80,000 minus 15%, so minus 15%, that is 8,52,550, that will be taken as the WDV, and the sale price is 5 lakhs, margin is negative, so GST not payable. Is it clear? Sale price minus depreciable value, sale price will be 5 lakhs and depreciable value will be 8,52,550. So as the sale price is less than the depreciable value, we don't have to pay any GST on that. If at all ITC has not been taken, and we have capitalized at full value. Is it clear? So they can connect this with notification 8 of 2018. So if they are nut and crack and all, they will ask. Next, question number 22. XYZ Telecom Limited is engaged in providing telecommunication towers and is expanding its network by laying new optical fiber cables across various regions. The OFCs are housed within PVC ducts, and service or connectivity manholes are installed as nodes in the network to facilitate maintenance and connectivity. The company has incurred significant expenses on purchasing these ducts and manholes. As they incurred significant expenses, definitely they will capitalize it. you are required to determine whether XYZ Telecom Limited can claim ITC on the purchase of ducts and manholes used in OFC network. So yes, as these are huge cost, they are capitalized in the books and they will fall under capital goods. Also it will come under plant and machinery other than telecommunication towers and pipeline laid outside factory. So therefore ITC available on this. Explain the rationale behind eligibility of ITC on these items referring to the relevant sections. The rationale for availment of ITC on all these things will be same. If something is not there in the block credit and it is used in the course or furtherance of business, we can definitely take ITC. So as the same is not covered under blocked ITC due to exceptions and it is used in the course or furtherance of business of telecom, they can avail ITC. Discuss whether there are any specific restrictions under 17.5 that would prevent XYZ Telecom from claiming ITC on these purchases. Yes, suppose if these parts are used for telecom towers, then they cannot take ITC with respect to that. Analyze the impact on XYZ Telecom Limited GST liability if these components were instead classified as excluded items under the definition of plant and machinery. If it is excluded from the definition of plant and machinery, then they cannot take ITC with respect to that. So that's how they can connect this particular circular. Then question number 19. Question number 19. Samsung Electronics sells a smartphone to a customer with a 1-year manufacturer warranty. During the warranty period, the customer experiences a defect and visits an authorized distributor who replaces the defective smartphone with a new one from their own stock. Samsung later replenishes the distributor stock without charging any additional amount. Additionally, at the time of purchase, customer buys an extended 2-year warranty from a third-party service provider, Warranty Plus, which begins after the manufacturer's 1-year warranty expires. You are required to determine the GST liability for Samsung on the replacement of defective smartphone under manufacturer warranty. So dealer is replacing, and for replacing out of his stock, whether he need to reverse any ITC? No, he don't have to reverse any ITC. Moreover, whether he need to treat it as supply under 71C? No. So see the answer for the first part. As per CBSE circular, when a dealer replaces a part or whole goods, GST not payable even though it is without consideration, as GST is already paid for the defective parts or goods. Also, dealer not required to reverse any ITC. Second part of the question you see. Explain the GST implication for Samsung when it replenishes the distributor stock with a new smartphone. When he replaces with a new smartphone, what is the treatment in that case? Replenishment. Who? Manufacturer. So whether the manufacturer replenishing, can manufacturer take ITC? Yes. And manufacturer sending it to the dealer, that will not be treated as supply and that will be under the cover of a delivery challan. As per CBSE circular, when manufacturer replenishes defective goods, that is smartphone, to the dealer, GST not payable by manufacturer. Also such manufacturer not required to reverse any ITC. Third part, discuss the GST treatment for the extended warranty provided by Warranty Plus. Warranty Plus, same person or different person? Different person. Warranty Plus is different person, considering it was purchased at the time of original sale but from a different supplier. It will be treated as independent supply and GST payable at the rate applicable to warranty, that will be 18%. If extended warranty charges is paid to different supplier at the time of purchase of product or at a later time, it is treated as separate supply and chargeable to GST at the rate applicable to extended warranty services. Analyze how the GST liability would change if the extended warranty was purchased from Samsung directly at the time of original purchase. Then it will be treated as composite supply. From the same supplier at the same time of purchase, it is a part of composite supply and GST payable at the rate applicable to the principal supply. What is the principal supply here? That smartphone. Whatever is the rate applicable to smartphone, that will be applicable even on the warranty charges also. Question number 7. You can see this question number 7. Larsen and Toubro L&T has entered into hybrid annuity model contract with the National Highway Authority of India for the construction, operation and maintenance of a highway. The contract specifies that L&T will receive payment in 20 equal installment over 10 years. Each installment is 10 lakhs, which includes 1 lakh as an interest component. So definitely 10 lakhs will be taken as the value because interest should be included in the value. the deemed date of completion of milestone event is 30th June. The due date of first installment is 1st July. What is the due date of installment? 1st July. And however, L&T issued the invoice for the first installment on 5th July. So, is invoice given within the due date? No. And the payment was received on 15th July. The applicable rate of GST for such contract is 18%. What is the due date of invoice as per section 31 subsection 5? As per section 31 subsection 5, as the due date, first priority is what? Due date of installment ascertainable. The due date of installment is the due date of invoice. What is the due date of installment? 1st July. So that 1st July 2024 will be taken as the due date of invoice. Okay. Then next, what is the time of supply as per 13(2) and what is the due date of payment of GST? As per section 13 subsection 2, if invoice given within due date, then invoice date, payment date, whichever is earlier. Check when the invoice is given, 5th July. Is it within due date? No. So therefore, we need to take date of completion or date of payment, whichever is earlier. Is the date of completion 30th June or 1st July? It is 1st July. Because date of completion will be taken as the date of invoice but not the date of completion of milestone event. So therefore, kindly make the correction to your answer in the book, because initially I thought it was date of completion, but later on only I have read that properly. So therefore, date of completion is the due date of installment. Due date of installment, that is 1st July 2024, or date of payment. What is the date of payment? 15 July 2024, whichever is earlier, that is 1st July 2024. If 1st July is the time of supply, then what will be taken as the due date of payment of GST? Next month 20, that is 20th August 2024 will be taken. Okay. Understood this? Then next one. Third part of this question, you see, calculate the GST liability for the first installment, that is same. Therefore, we need to take 10 lakhs into 18%, because entire 10 lakhs will be taken as the value including the interest component. So on that 18%. Then 4, what will be the time of supply if the invoice is issued on 1st July 2024? What is the due date? 1st July. Invoice also given on 1st July. So what should be taken as the time of supply, as invoice is given within the due date? So invoice date or payment date, whichever is earlier, same, that is 1st July only will be taken. So next month 20th will be taken as the due date of payment of GST. Understood this circular here? And related to this circular, I have given one more question. I coined one question in the test series. You can see that question. Okay. Question number 8. Reliance Jio has successfully bid for the allocation of spectrum by the Department of Telecommunication under the Government of India spectrum allocation model. The total bid amount for the spectrum allocation is rupees 1000 crores. Reliance Jio is given two payment options. Option 1, make a full upfront payment of 1000 crore on or before 30th June 2024. Option 2, pay 10 equal installments. The first installment is due on 1st July with each installment comprising both principal and interest. The installment amount considering an annual interest rate of 10% is as follows. They gave, this is the frequency assignment letter. I told you, na, they will mention which installment, how much is the amount and by when it should be paid, like that. The frequency assignment letter from DOT specifies this payment option, also states that GST at the rate of 18% applicable on the spectrum allocation. Assume that invoice is issued by DOT on 15 June. Actually, invoice is irrelevant here. And you are required to determine the following. Number 1, determine when GST liability arises if Reliance Jio opt for full upfront payment and calculate the GST amount payable. Assume that the payment is made on 28th June. In case of full upfront amount, by when they should make payment? 30th June. When are they making payment? 28th June. Whichever is earlier will be 28th June. That's it. Then second, what will be your answer in one above if the payment is made on 5th July and such delay is condoned? Then 30th June. 30th June or 5th July, whichever is earlier will be 30th June. Determine the GST liability, timing and amount if Reliance Jio chooses to pay in installments, and specifically calculate the GST payable for the second installment due on 1st July, but they are making payment on 30th June. So whichever is earlier will be 30th June. And what is the GST amount? 144 crore. But it includes interest. Let it be. This is interest on account of delay in receipt of consideration, that should be included in the value and chargeable to GST. And as 30th June is the time of supply, next month 20th, that is 20th July, will be taken as the due date of payment of GST. What will be your answer? What will be your answer in 3 above? If the payment is made on 4th July and such delay is condoned by DOT, what is the due date? 1st July and 4th July, whichever is earlier will be 1st July. So next month 20th will be taken as the due date. Understood? Question number 1, page 647. ABC Private Limited, an Indian entity, secured a loan of 1 crore from its overseas affiliate XYZ Incorporation based in the United States. The loan was provided at an interest rate of 6% per annum for a tenure of 3 years, with interest being the only consideration charged. Whether the interest on loan paid to XYZ Incorporation is treated as supply and chargeable to GST. So just now we discussed that whenever there is a holding company and a subsidiary company, holding company outside India and the subsidiary company is in India, if they pay only interest, then it is not a supply. Import of service by way of loans or advances against consideration in the form of interest or discount is not treated as supply. Accordingly, ABC Private Limited securing loan from XYZ Incorporation against interest of 6% per annum is not a supply, and consequently it is not chargeable to GST. However, if the Indian affiliate pays consideration, then it will be. So see the next part. What will be your answer if, okay, what will be your answer if in addition to the interest, XYZ Incorporation also charged a processing fee of 1,50,000 for facilitating the loan? Then that 1,50,000 will become supply under 7(1)(b), and it's an import of service other than OIDR services imported by non-taxable recipient or other than non-taxable recipient. Other than non-taxable recipient. Why? Who will come under non-taxable recipient? Individual, trust, government. So here it is not individual, trust or government, it will be others. So therefore it will be covered under RCM. Okay. So therefore say this. Chargeable to GST under RCM. In the present case, ABC Private Limited shall pay GST on rupees 1,50,000 paid to XYZ Incorporation as processing fees. Then look into another question. Question number 3. This is also on that circular related to ESOPs. Unilever PLC, a foreign holding company, offers an employee stock option to the employees of its Indian subsidiary Hindustan Unilever Limited as a part of their compensation package. Under this plan, Unilever PLC issues 10,000 stock options to the employees of HUL, allowing them to purchase shares at a predetermined price of 200 rupees per option. At the time of the grant, the market price per share is rupees 300 and the options have a vesting period of 3 years. After the stock options vest and are exercised by the employees, Unilever PLC charges HUL 20 lakhs as the cost of the shares. Logic simple, 10,000 stock options into 200 rupees per option, 20 lakhs is the cost of the shares, which HUL reimburses on a cost to cost basis. Additionally, Unilever PLC charges HUL an administrative fee of 2 lakhs for managing the ESOP on its behalf. Assume the applicable GST rate on service is 18%. Now, first, determine whether the 20 lakhs reimbursed by HUL to Unilever for the cost of the shares is liable to GST. No. As per CBIC circular, whenever the holding company is allotting ESOPs to the employees of the subsidiary company, for which subsidiary company just paid the cost, that is not a supply. Then calculate the GST liability on the additional 2 lakhs charged by Unilever PLC as an administrative fee and determine who is liable to pay GST. With respect to additional charges for that ESOP, it is a supply under 7(1)(b) and chargeable to GST under RCM. So GST will be payable on that. What is the administrative charges? 2 lakhs. Compute the total amount HUL need to pay to Unilever PLC. 20 lakhs plus 2 lakhs, 22 lakhs. But the GST will be payable to government. So 2 lakhs into 18%, 36,000. Can the GST on additional 2 lakh be availed as ITC? Yes. We don't have any blocked credit and it is used in the course or furtherance of business. So definitely they can take ITC. GST paid under RCM can be availed as ITC if the condition for availment of ITC is fulfilled. Then next one, look into question number 4. This question number 4 is related to the renting. So see that Mr. Rahul, an individual registered under GST, owns multiple residential and commercial properties across different cities in India. In October 2024, he rents out the properties under different situations to various individuals and entities. Compute the value of taxable supply in the hands of Mr. Rahul based on the following details of the rentals for October 2024. So we need to just compute the value of taxable supply. First, renting of a luxury residential flat. It's a residential flat to Mr. Kapoor, a proprietor of a proprietorship concern for the personal use as his residence. What is your answer? Exempted. Whether Mr. Kapoor is registered or Kapoor is unregistered, it is exempted. If Kapoor is unregistered, also anyhow exempted. Even if he is a registered individual, also it is exempted because he is taking it for his personal residence. So this 40,000 will be exempted. Renting of student hostel in Pune to 20 students for a period of 6 months from October 2024. Period of 6 months means more than 90 days. And what is the charges? 12,000 per month, which is less than or equals to 20,000. Therefore, it will be exempted. Then next, offers PG accommodation in Delhi for 10 working professionals for a period of 4 months. For working professionals also, all accommodation for a period of 4 months. 4 months means definitely 90 days or more, and the charges less than or equals to 20,000 per month. Therefore, it is exempted. Renting of guest house accommodation in Bengaluru to a corporate company for its employees, and accommodation is used for consecutive 90 days. Even then it is exempted, because for a corporate company also they have not given like it should be for this person only, like that. All accommodation, it is accommodation only na? Yes. So 90 days, how much is the charges? 19,000. Okay, so which is less than or equals to 20,000. Renting of hostel in Chennai for 40 days, 40 students pursuing CA final for attending exam oriented batch on IDT of Mr. THARUN'S for a consecutive period of 60 days. What is your answer? Even though the charges is less than or equals to 20,000, but the number of days should be minimum 90 days. Here it is only 60 days. Due to that reason, it will be taxable, and it will be taxable in the hands of Mr. Rahul, supplier. Okay. Then next, renting of commercial property in Bengaluru to XYZ Limited, a registered company for office space, 1,50,000, definitely taxable. But sir, in case of commercial property, we have RCM only when supplier is unregistered. Here supplier is registered. Then offers PG accommodation in Kochi for 10 students who pursue a short-term skill course for a consecutive period of 90 days. Even though it is for a consecutive period of 90 days, but the charges is not less than or equals to 20,000. So that will be taxable. So in this case, first one, this 10,000 will be taxable, 40 students. So 40 into 10,000, that will be 4 lakhs. Next one directly 1,50,000. Last one 10 students into 25,000, that is 2,50,000. So the total will be 8 lakhs. Then look into question number 5. ICICI Lombard General Insurance provides coverage for the coconut palm insurance scheme, a government sponsored scheme. The scheme is exempt from GST under serial number 35 and 36 of notification. And this is a government notified scheme, therefore that insurance is exempted. In October 2024, to manage its risk, ICICI Lombard enters into the following reinsurance arrangements. Situation 1. ICICI Lombard cedes a portion of this risk associated with the coconut palm insurance scheme to General Insurance Corporation of India, another Indian reinsurer. The reinsurance premium for this transaction amount to 4 crores. See, as the main insurance is exempted, its reinsurance is also exempted. Situation 2. GIC-RE in turn cedes a part of the reinsured risk to Munich RE, a cross-border reinsurer based in Germany. This transaction, classified as retrocession, involves a premium of 2 crore. As the reinsurance is exempted, its further reinsurance, that is retrocession, is also exempted as per CBIC circular. So that is the answer for this. Then another question you see. Question number 6. Air Europa Limited, India. The Indian establishment of Air Europa Limited, a foreign airline company incorporated in Spain, provides various services as part of its operations in India. The airline company imports certain administrative and operational services from its head office in Madrid, Spain, without any consideration. This is related to that import of services, that Indian establishment of a foreign airline company point. This service includes IT support, financial management, legal advisory service and staff training. Compute the value of taxable supply on which Air Europa Limited is liable to pay GST under FCM or RCM. Last line you see, what will be your answer in the above case if Government of Spain is not giving any exemption to Indian airline company operating in Spain. So now we need to divide it into two. First, if Government of Spain is giving reciprocal exemption, if Government of Spain is not giving reciprocal exemption. Now, starting with the first point. First, their outward supply you see. Outward supply is what? Passenger transportation, cargo transportation services. So they need to pay GST on that. For that, there is no exemption. So whether we have any exemption for passenger transportation, cargo transport service of airline, no, that will be taxable. For airlines, what is exempted for transportation? Starting point, ending point in northeastern states or Bagdogra in West Bengal, or viability gap funding, that is not given. And goods also, if it is outside India to India exempted, that is not given here. So therefore, these two services will be taxable, which is their outward supply. Whether Government of Spain gives exemption or not give exemption, for the Indian establishment, GST will be payable on this at 18%. So see the answer, first two rows. So outward supply, passenger transportation, cargo transportation, 2 crores into 18, 1.5 crores into 18. So 63 lakhs is their gross GST payable under FCM on outward supplies. On outward supplies, they only should pay. Next you see, they have given inward supply. First inward supply, IT support services imported from head office in Madrid without consideration. Okay, so it is exempted, provided if the Government of Spain gives reciprocal exemption. You can see here, support services from head office in Spain exempted as the same is imported from head office without consideration if Government of Spain gives reciprocal exemption. What if Government of Spain is not giving reciprocal exemption? Then in that case, analyze. It is import of services for consideration or without consideration? Without consideration, but from a related person. So it will be supply under 7(1)(c). Is it OIDR or other than OIDR? Other than OIDR. Other than OIDR by non-taxable recipient? No. Air Europa Limited. Limited will not come under non-taxable recipient because they are not individual or trust or government. So other than NTR, and there is no reciprocal exemption. So it will be taxable under RCM. So they need to pay GST. What is the value given here? 25 lakhs. So 25 lakhs into 18%, 4,50,000. So import of other than OIDR by other than NTR exempted only if Government of Spain gives reciprocal exemption to foreign establishment of Indian airline company. Then next one, second inward supply, legal advisory services imported from head office in Madrid for consideration. For consideration, there is no exemption. So this exemption of Indian establishment of a foreign airline company is applicable only in case of without consideration. Logic is simple. There is no consideration means no outflow. That's the reason why they have been given this exemption. If there is a cash outflow, they are not giving this exemption. So for consideration, no exemption. In both the cases, it will be taxable. Why, sir? It is from head office for consideration, supply under 7(1)(b), and it is coming under OIDR, other than OIDR, other than OIDR by other than non-taxable recipient. Therefore, it will be taxable under RCM. So on 15 lakhs, they need to pay GST 2,70,000, 2,70,000. So sorry, 20 lakhs into 18%, 3,60,000, 3,60,000 exemption not available as the same is import for consideration. It is other than OIDR by other than non-taxable recipient. The next one, marketing services imported from Google Incorporation for a consideration. It's a OIDR service. It's not from head office PAP. That's why no exemption. So definitely it will be taxable. OIDR service always taxable. Who will pay? If imported by NT or it is FCM, otherwise RCM. Here it is Air Europa Limited, it's a company and they are registered in India. So why sir they are registered in India? See their outward supply are 2 crores, 1.5 crore. Definitely they will be registered here. So where is the question of not getting registered? Definitely they are registered. So therefore they will not come under NTOR. So they will be other than NTOR. So it will be coming under RCM. So 15 lakhs into 18%, 18%. Import of digital marketing services, OIDR services by other than NTOR. Next. So catering service received from a person in India, that is not under RCM. That's not import of service, normal services. So these are the only 3, and on this GST payable under RCM. So I told you while doing a 14 marks question, 4 statements we need to prepare. First statement is what? Outward supplies. Second statement is what? GST payable and inward supply. GST payable or inward supply under RCM. Third is what? ITC. Whatever GST you paid under RCM, you can take as ITC. On this catering service, can't we take ITC? No. Outdoor catering is a blocked credit. And 3 exceptions are there. Inward supply, outward supply, same category, not applicable. Inward supply, part of outward supply, not applicable here. And statutory obligation, not applicable. Consequently, ITC not available here on this catering service. So 6,30,000. Now computation of net GST payable. And you see what is there, ITC very less only compared to their liability. Their liability is 63 lakhs. ITC is just 6,30,000 only. So don't apply rule 86B. First, gross GST under FCM 63 lakhs minus ITC utilized. Here it is 6,30,000 and here it is 10,80,000 and RCM liability. So 63 lakhs and 63 lakhs will be taken as the net liability. Understood? So related to this point of exemption, they can make a question like this, connecting with other import of services, because it's high time. Import of services they have not at all tested in the last 3-4 attempts. So they can ask. Moreover, there is an amendment in that import of services. That's why I have given a possible question like this. They can coin a question. Tech Hub Data Services Private Limited, an Indian data hosting service provider, enters into contract with Cloudcom Solutions, a cloud computing service provider based in Singapore, for providing data hosting services. Tech Hub operates a large data center in Bengaluru, which Cloudcom uses to host its cloud computing services. The agreement stipulates that the Tech Hub will handle the infrastructure management, equipment maintenance and IT monitoring for the cloud services offered by Cloudcom. They entered into contract on April 1 with an annual service fee of 10 crores, foreign exchange converted to Indian rupees, where the payments are made on a quarterly basis. Evaluate whether the data hosting services provided by Tech Hub to Cloudcom qualify as intermediary services. No, it is not intermediary services, as the contract is on principal to principal basis. Determine the place of supply for service provided by Tech Hub to Cloudcom based on the given facts. So what will be taken? We need to apply general provisions, and location of recipient should be taken as place of supply. What is the location of recipient? So Singapore will be taken as the place of supply. Then third, analyze whether the services provided by Tech Hub Data Services qualify as export of service. So in order to become export of service, 5 conditions should be satisfied. Supplier should be in India. Yes, Tech Hub is located in India. Recipient should be outside India. Yes, that is in Singapore. Place of supply, location of recipient, that is Singapore. And they are receiving convertible foreign exchange. Supplier and recipient are not two establishments of the same person. So as all the conditions are satisfied, it is an export of service. Determine the place of supply. If Cloudcom Solutions is an entity based in India, if it is an entity based in India, there is no confusion, because always general provisions, location of recipient only will be taken as place of supply, that is in India. Next, we have 8th one. Where is the place of supply in case of services by an advertising agency to a foreign client, where such advertising agency provides comprehensive advertising services including recovery of charges paid to media owners. For example, say there is one mobile company. That mobile company wanted me to do the advertising in India. So they are telling like, so you are an advertising company, you know the pulse of the audience here, So therefore, you please do the promotion. So thereby we will get a good thing, and we will give the entire contract to you. You only pay the media channels like digital marketing, like everything you do, and you pay to the media houses like TV channels, etc. You pay, and whatever is the amount you recover from us, which means I am not an intermediary. Why I am not an intermediary? I am not just connecting the TV channels and the foreign company. I am also doing the advertisement design. So due to that reason, I will not be called as a intermediary, because the strategizing is very, very important. Because if you are not properly strategizing, then no one will know about it, and it may backfire also. So for that, a careful strategy and implementation is required, that is beyond just connecting the seller and the buyer or supplier and the recipient. So the advertising company is providing services to a foreign client on principal to principal basis and is not acting as an intermediary. So the place of supply will be as per general provisions, and it may qualify for export of services. So another question. XYZ Advertising Private Limited, based in Mumbai, provides comprehensive advertising services to Global Fashion Limited, a company headquartered in the UK. The service involves end-to-end campaign management, including media buying, content creation, strategy and design. XYZ Advertising has entered into 2 agreements, one with the foreign client, that is Global Fashion Limited, for managing the advertising campaign, and the other with an Indian media company to purchase media space for the advertisement. Okay, basically they enter into 2 contracts, one with the foreign client Global Fashion, another with the Indian media company to procure the space for advertisement. The cost structure for the project includes 20 lakhs for the media space subject to 18% IGST, and 10 lakhs for content creation and strategy services also subject to 18% GST. XYZ Advertising invoices Global Fashion Limited for rupees 30 lakhs, 20 lakhs for media space and 10 lakhs for other services, and receives payment in foreign exchange. The media company issues a separate invoice to XYZ Advertising. The problem is that expenditure incurred as a pure agent will not come. Read the question carefully. In case of expenditure incurred on pure agent point to get attracted, the invoice should be in whose name? See, here XYZ Advertising Agency is the supplier, and they are incurring the expenditure on behalf of the recipient, but the invoice should be in the name of the recipient, but the invoice is in the name of supplier XYZ Advertising. So the pure agent point will not be applicable in this case. Is it clear? Because in order to become pure agent, so 4 conditions should be satisfied. Contractual obligation, wherein through contract recipient should authorize supplier to incur the expenditure. Only the actual amount incurred should be recovered, and the title should not be in the name of the supplier, and it should not be used for the personal purpose of the supplier. Here title is in the name of the supplier, that's why pure agent will not come. Point number 1, will XYZ Advertising be considered as intermediary in this transaction? No, not considered as intermediary, because they are acting on a principal to principal basis and they are providing advertisement services. Therefore it is not just connecting the media house and the Global Fashion Limited. So it is not an intermediary service. Number 2, what is the place of supply for the service provided by XYZ Advertising? General provisions. Location of recipient should be taken. What is the location of recipient? That Global Fashion is in UK, that will be taken as place of supply. Whether service provided by XYZ Advertising fall under 0 rated, so supplier should be in India. First it is 5 conditions. Supplier should be in India, yes. Recipient should be outside India, yes. And place of supply should be outside India, yes. Consideration should be in convertible foreign exchange. So is it given that consideration is in convertible foreign exchange? Yes. Receives payment in foreign exchange. Then supplier and recipient are not two establishments of the same person. So yes, it will become export of services. 4. Can XYZ Advertising avail ITC with respect to payment made to media company? So XYZ can avail ITC because the point is that invoice is in the name of XYZ Advertising. So yes, they can definitely avail ITC with respect to that. Then can XYZ consider the payment made to media company as expenditure incurred as a pure agent in terms of Rule 33? So we are connecting place of supply with value of supply. No, cannot be considered. Why? Because invoice is in the name of the supplier and conditions for pure agent is not fulfilled due to that reason. Then last circular, Where is the place of supply in case of custodial services offered by banks or financial institutions to foreign portfolio investors? Foreign portfolio investors will approach lot of banks for the purpose of receiving custodial services. Custodial service means the bank will act as a custodian for the equity investment made by the foreign portfolio investors in Indian companies. So whatever meetings, participation in the meetings, or dividend, collection of dividends and retention of that equity instruments, everything will be done by these banks. And whether this is coming under banking services to account holders? No, because foreign portfolio investors will not be having any account with the bank. Yes, it's a banking service, but if you see only banking services to account holders, place of supply will be location of supplier, as it is not to account holders. So general provisions, got it? Say this, as foreign portfolio investors are not account holders of bank, not account holders of banks or financial institution, place of supply is determined as per general provisions. Okay, so one more question, you say this, question number 12. ABC Bank Limited, a leading bank in India, provides custodial services to XYZ Investment Group, a foreign portfolio investor registered in USA. ABC Bank safeguards the financial assets of XYZ Investment Group, maintains records, facilitates transaction settlements and collects dividends on behalf of FPI. The details of the service provided by ABC Bank Limited are as follows. Custodial service fee, how much they are collecting? 50 lakhs for the financial year. Then location of service provider Mumbai, location of recipient New York, USA. Determine the place of supply. Definitely it is not banking services to account holders. So due to that reason it will be general provision. So USA will be taken. Then will the custodial services qualify as export of service? Yes. Supplier in India, recipient outside India, place of supply outside India, and is the custodial fee in convertible foreign exchange? So is it given that it is in foreign exchange? So details of services, no, there is no information. So we need to take the assumption that the consideration is received in convertible foreign exchange. Then supplier and recipient are not to establishments of the same person, then it will become export of services. If nothing is given, you take in the question if, you put a if like that. If the consideration is in convertible foreign exchange, then it will become export of services. Put a if condition and give. So answer positively, don't answer negatively. Always to the extent possible answer positively, okay? Positivity helps. Then next, what will be your answer if the custodial services are provided to Indian investors? Then anyhow, we need to take general provisions only, because the confusion is only in case of section 13, because banking service to account holders we have a different provision, but when it is to banking service to Indian people, so we don't have any specific provision. By default it will be general provision.